Assalamualaikum. We will answer the case analysis of Dundee Corporation.
Dundee Corporation is operating under the manufacturing industry, mainly under the water purification equipment production industry. This industry can be considered stable as the demand for its product is quite high considering the increasing number of population in Malaysia, leading to the increasing number of residential construction, which clearly needed for this industry's product for its water or pipeline system.
For company analysis, Dundee Corporation has experienced a decline in profit, particularly in its online due to the need to match competitive price reduction. This indicates high competition and a lack of pricing power in the market for pumps. The gross margin for pumps has fallen below 20%, significantly lower than the planned gross margin of 35%. This suggests that the cost structure or the pricing strategy need re-evaluation. Dundee manufactures three main product lines, which is pump, valve, and flow controller. All these three products use the same equipment and labor, indicating a shared cost structure. However, the manufacturing process and the complexity differ, particularly for flow controller, which are more labor intensive and require more components. The company uses a straightforward cost accounting system where the overhead are allocated as a percentage of direct labor costs, currently at 30%, and this method, while inexpensive and simple, may not be accurate to reflect the true cost of production, especially for a product with different level of complexity and labor requirement. Bragi Knight noted that Dundee variable costs are direct material and labor. If competitors are pricing product based on contribution margin, then it might be at a disadvantage if its overhead allocation distort the product profitability.
Dundee Corporation operates as Strategic Business Unit, which also known as SBU. SBU aims to maximize profit while minimize the cost of production for each product they produce. It can be seen from the study case that Dundee Corporation produce products for manufacturers of water purification equipment, which are pumps, valves, and flow controllers. All the costs of production are controlled and managed by the company's manufacturing managers.
Start by answering question 1 in analysing the current financial performance of the Dundee Corporation. The financial performance of Dundee Corporation has been under pressure due to the increased competition and price reduction in its major product lines pump. Since it is a commodity product, hence Dundee also need to decrease their price when competitors are reducing their price, because Dundee need to match the price to maintain its volume. Hence, when the price of the product reduces, then the profit of the company will drop as well. The gross margin of the pump for the latest month have dropped below 20%, significantly lower than the planned gross margin of 35%. Despite maintaining the sales volume by matching competitors' price, the profitability has been adversely affected. Alright, and the right side you will see the breakdown of each product and the recent report of each of it. As of the pump sale, it falls significantly below the planned gross margin. Every month, the price of the pump decreased, but Dundee nonetheless need to match the price so that they didn't give up their place as a major pump supplier. Second, on the flow controller, Dundee had increased 10% of its price, however, demand is not affected, and this increase might be due to cover the loss earned for their primary product line. Lastly, product which is valve. It doesn't mention explicitly, but the production process is similar to pumps, suggesting that they have the similar cost structure. But out of the three products of the Dundee, they concern more on the pumps, and it is their primary and major product. It's been causing the company to decrease in profit. Hence, the major concern of this if it is reduced gross margin for the pump and increased competition and price sensitivity. Thank you.
The second requirement is to calculate the profitability of Dundee's three product line using the activity-based costing method. So the first step is to determine the activity rates. Firstly, we need to identify the activities that Dundee has in their production, and here we could conclude that they have 4 activities: setup labor, receiving and production control, packaging and shipping, and the last one is engineering. So the next step is to calculate the cost driver rate, which can be done by dividing the budgeted cost of the activity with the total cost driver transaction. And with that, we will derive to the cost driver rate for each activities. The next step is to calculate the total cost per product. So Dundee has 3 product lines which are valve, pumps, and flow controllers. So using the information given in the question, we included the direct material and the direct labor costs. As for the manufacturing overhead, we will need to multiply the cost driver rate that we have calculated before for each activities with the production of the product, deriving us to the total cost of the product. So after that, we will divide the total cost with the production amount of the product to calculate the per unit product cost. So here, by comparing the per unit product cost using the activity-based costing system and the current system that Dundee use, we could see that the activity-based costing system resulting to lower per unit product cost for product valve and pumps, but almost 40 ringgit increase in the per unit product cost for flow controller.
In step 3, we will see the comparison in terms of profitability between ABC costing system and current costing system. As we could see in the box below, for ABC costing system, the operating income is $57,616, while actually in the current costing system, the operating income only $57,600. So the there are difference between the ABC costing and current costing system, which is a difference of $16, which is if the company choose to record using ABC costing system, eventually the profitability of the company will be increased by $16, which also means that actually by using ABC costing system, the company can actually have more profitability because the manufacturing overhead is allocated in more details to each product.
Hi, Assalamualaikum. My name is Nurul Nadia Zainuddin. My matrix number is 2229002. So I will explain about the analysis on what action should Dundee management take to improve their profitability. So the first one, Dundee should consider increasing the selling price of pumps, which can help to recover the high cost and improve the overall profitability. Dundee should also be cautious about their competitive market and potential impacts on demand. Second, the pump machining costs look higher than the valve and flow controllers. So Dundee should explore ways to reduce the cost, such as investing in more efficient machinery, optimizing the manufacturing process, or finding alternative machining methods which can help to lower the overall cost of production for the pumps. Third, the cost of quality control for flow controllers is higher than the valve and pumps, which indicates a potential quality issues. Thus, Dundee should investigate and improve their quality control process for the flow controllers to reduce the cost. Dundee can either involve themselves in better training for quality control staff, more rigorous testing procedures, or enhance their quality assurance protocols. Next, the profit for valve is high and the production costs are low. So Dundee should continue to focus on valve production and consider in making a way to enhance their market share. The way they could involve themselves is by involve themselves in the marketing efforts, exploring new market, or further optimizing the production process to maintain a low cost. Next, Dundee should also conduct a detailed analysis on specific activities for the production line to identify potential cost-saving opportunities, which may indicate that which may involve cutting back on certain activities like setting up labor or receiving and production control, which can reduce the overall production cost. Dundee also should investigate if there are any alternative suppliers who can provide them materials at a lower cost but without compromising the quality. This could help Dundee to reduce the direct material cost and improve the overall cost structure. And lastly, Dundee should implement the activity-based costing system to continually monitor and manage costs, ensuring more accurate pricing and cost control. And that's all for me. Thank you.
For the management accounting concept, it is essential for decision making, especially in a competitive market where accurate cost allocation and strategic pricing are crucial. At Dundee Corporation, several key management accounting concepts are important in addressing their financial challenges, particularly in the pump product line. So for the first concept, which is cost allocation. Cost allocation for the Dundee Corporation is currently allocates overhead costs based on direct labor costs, which may not accurately reflect the true cost of producing each product. This method can lead to undercosting complex products like flow controllers and overcosting simpler ones like pumps, distorting pricing and profitability decisions. For the second one is activity-based costing, which is ABC. ABC is a refined approach that allocates overhead costs based on actual activities and resources used by each product, which is implementing ABC at Dundee would provide a clearer picture of true costs and ensuring more accurate pricing and production decisions. The third one is contribution margin. The contribution margin, the difference between sales revenue and variable costs, it is a key profitability indicator. Understanding it helps Dundee Corporation evaluating their pricing strategies impact and adjust prices to maintain a positive margin, even amid competitive price cuts. Lastly, cost management. Effective cost management involves identifying, controlling, and reducing costs to improve profitability. For Dundee, this means optimizing production processes, reducing waste, and negotiating better supplier terms. Implementing cost control measures, particularly in the pump production process, can help maintain or improve margins despite competitive pressures. By focusing on these four management accounting concepts, Dundee Corporation can enhance financial performance, make strategic decisions, and improve profitability. Next, move on to the role of management accountants and their ethical obligation cost management decisions. For the management accountants, it is essential to maintaining an organization's operational effectiveness and financial integrity in the modern corporate world. When managerial choices have the potential to compromise the integrity of financial reporting, this function becomes even more crucial. The recent decision made by the Dundee Corporation senior management, which is to skip over the activity-based costing, it is put the management accountant in the difficult, upright, and professional position, which is mean the duties and proper course of action for a management accountant in this kind of situation are looked in this company with a focus on upholding professional ethics and giving accurate financial information. A management accountant is first and foremost bound by professional ethical norms, which is professional skill and caution. The use of the ABC system is one of the best practices in cost management that the management accountant has to keep current on. Unlike the older techniques that could employ arbitrary allocation basis, the ABC system allocates overheads based on real activities, providing a comprehensive and accurate view of product costs. For the purpose of determining each product line's actual profitability and making wise strategic choices, this decision is crucial. The management accountant at Dundee Corporation has an obligation to explain the advantages and need of implementing the ABC system to upper management in the event that they choose not to do so. This implies carrying out a thoroughly researched case that demonstrates how the ABC approach may uncover hidden expenses, stringent pricing tactics, and boost overall financial performance. So, particularly compelling is a comparison of product profitability using the ABC approach versus the traditional costing system. Through a graphic representations of the differences and advantages of moving to ABC, the accountant may present a strong case for its implementation. It is essential that management accountants analyze and convey the risks involved in sustaining the present costing system, in addition to encouraging for the ABC method. Risks include of improper pricing, possible market share loss, and a general financial mismanagement. A comprehensive risk assessment can assist management in understanding the decision's long-term effects and the future consequences for the company's financial stability. For the summary, the management accountant at Dundee Corporation is responsible for maintaining the highest standards of professionalism and ensuring that financial reporting is accurate. The accountant promotes the integrity and long-term performance of the business by evaluating risks, clearly conveying the benefits of the ABC system, and recording their expert recommendations. Also, navigating the difficulties posed by management's choice to disregard the ABC system requires dedication to moral principles and support for cost management best practices. So that is all from our group about the case analysis of Dundee Corporation. Thank you for watching, and Assalamualaikum warahmatullahi wabarakatuh.
There is at least 5 courses of action that can be done by Dundee Corporation, which is first to adopt the activity-based costing. When implementing ABC, will allow Dundee Corporation to allocate overhead costs more accurately based on the actual activity and resource usage. This will provide a clearer picture of the true cost and profitability of each product line. Second, they need to review and adjust their pricing strategy. With the more accurate cost data from the ABC costing, Dundee can revisit its pricing strategy, especially for farm. Instead of matching competitors' price blindly, the company can make informed pricing decisions based on its cost structure. Thirdly, to focus on the high margin product, which is the stable demand and recent price increase for the flow controller, Dundee should prioritize this product line. Increasing production and sales output for flow controller can help offset the lower margin for pumps. And then, they can implement cost control measures, which to introduce cost control measures, particularly in the production process for pumps, can help maintain the margin. This includes optimizing production runs, reducing waste, and negotiating better terms with supplier and semi-finished component. Lastly, to explore diversification and innovation, Dundee should explore new market or product innovation to reduce dependency on commodity product like pumps. Developing differentiated product with unique features can help to avoid the direct price competition and maintain healthy margin.
So for the rationale for the recommended course of action, the first one is accuracy and informed decision. So by implementing ABC system, we can provide a more accurate allocation of overhead costs and to lead a better informed pricing and production decision. And next is profitability focus. So by focusing on the high margin products and accurate cost data, the Dundee Corporation can improve its overall profitability. Next is competitive edge. So the cost control measures and innovations can help Dundee Corporation to stay competitive without solely relying on price cuts. And last one is ethical responsibilities. So by implementing accurate costing methods, we can ensure ethical financial reporting and decision making, adhering to the management accounting principles. And by adopting these actions, Dundee Corporation can enhance its financial performance, making it more strategic decision and improve overall profitability in a competitive market. So for the conclusion, considering the difference in the product demands for indirect resources, the high overhead levels, and the lack of direct relationship between production volume and the activity, we suggest transitioning from traditional volume-based costing to the activity-based costing. Because utilizing the unique cost information from activity-based costing, we can advise the company to reassess its approach to the flow controllers. Given the absence of the price competition, the customized nature of the product, and the price inelastic demand. So Dundee may adjust the prices of individual flow controllers to ensure a healthy profit margin. So one approach to achieve this involves establishing pricing based on the specific resources used in activity-based costing for each product or customer. So additionally, the company could explore a series of measures to lower the expense of flow controllers, such as modifying their design, optimizing the production process to minimize the resources wastage, and transitioning to batch post-production and delivery to reduce cost per unit linked to production and shipment quantities.